In the 70s, Americans witnessed a dramatic erosion in the value of their money. A new car that cost $3,400 in 1970 had doubled to $7,200 by 1980. Home prices tripled, rising from $23,000 to $64,000. Essentials like milk and beef doubled, and gasoline prices quadrupled. Over that decade, the US dollar lost roughly half its purchasing power. Saving $1,000 in 1970 meant having the equivalent of just $500 in buying power by 1980. This kind of inflation isn't just a relic of the past. It's happening again. Since 2020, the dollar has already lost about 25% of its purchasing power. Home prices have surged from $350,000 to $500,000. Gasoline has nearly doubled, and food staples like beef and eggs have tripled. These shifts have triggered the most significant inflation spike in the US since the 1980s. The key metric for tracking this is the Consumer Price Index, CPI, which measures how the cost of everyday goods and services changes over time. It includes housing, food, energy, transportation, healthcare, and more. In 2022, the CPI showed inflation peaking at 9%, a level not seen in decades. Since then, inflation has cooled, hovering between 2% and 3%, which is in line with the Federal Reserve's target. But there's growing concern that this trend may reverse. To understand what's driving inflation today, we need to look at the components of the CPI. Shelter, primarily housing and rent, is the largest contributor. It's also one of the slowest moving. Since early 2023, shelter inflation has been steadily declining. After a sharp rise in home prices between 2020 and 2022, the market has cooled. High mortgage rates and affordability issues have pushed housing activity to levels not seen since the 2008 financial crisis. Unless demand rebounds, shelter is unlikely to drive inflation higher in the near term. Historically, the biggest inflation spikes have been driven not by shelter, but by food and energy. These categories are more volatile and can swing sharply. In 2021 and 2022, rising oil and food prices were the primary forces behind the inflation surge. Higher oil prices mean higher transportation and production costs, which ripple through the economy and push up prices across the board. Some analysts have speculated that rising energy demand from emerging markets like India and China could reignite inflation, but the data tells a different story. China's oil imports have remained flat since 2019, held back by a housing crisis and demographic challenges. India's demand has grown, but it still accounts for only about 3% of global consumption, too small to move the needle. Meanwhile, global oil supply has outpaced demand, and the US is producing oil at record levels. With the economy cooling, energy prices are unlikely to spike. That leaves core goods and services. These were major contributors to inflation during the pandemic, driven by supply chain disruptions, massive government stimulus, and a tight labor market. At the time, global logistics were strained, the US money supply surged, and job openings far outnumbered available workers, pushing wages and prices higher. Today, those pressures have eased. Supply chains have normalized, money supply growth has slowed, and the labor market has softened. All signs point to continued disinflation. So why are some economists warning of a potential uptick in inflation? The answer lies in tariffs. Since February 2025, federal tariff revenue has more than tripled, from $7 billion to $26 billion. While consumers haven't yet felt the full impact, businesses are already paying more for imported goods and materials. This is reflected in the ISM Prices Paid Index, which tracks how much companies are spending on inputs. Over the past few months, this index has risen sharply. Historically, it's been a reliable predictor of future inflation, as businesses eventually pass higher costs on to consumers. This doesn't mean we're heading back to 1970s style inflation. A return to double-digit inflation is highly unlikely, but a temporary rise above 3% is plausible, especially if tariffs continue to pressure input costs. This could have meaningful implications for financial markets, particularly the US Treasury bond market, which is sensitive to inflation expectations. Fortunately, Tariff-driven inflation tends to be short-lived. Unlike energy shocks or wage spirals, tariffs represent a one-time cost increase. Once prices adjust, the inflationary pressure fades. That means after a brief bump, inflation could resume its downward trajectory, potentially creating favorable conditions for equities and other risk assets. For investors and traders, understanding these macroeconomic dynamics is essential. Those who can interpret inflation trends and anticipate policy responses are better positioned to navigate market shifts. If you're interested in learning how to trade based on these insights, I've put together a video that walks through the strategies I've developed over years of studying macroeconomics and financial markets. These are timeless lessons that can help you outperform in any environment. Thanks for watching, and stay sharp.